Well, it's that time of the year when all the market attention is clearly centered around one event, which is budget. What should finance minister do? What will he do? And the big question is, what can he do rather to kickstart the broken down investment cycle? From a market standpoint, markets are sitting at historic levels. How much of the good news is in the price, and what will really change the market momentum in the short term? To discuss all that and much more, I have with me Hiren of Alchemy. Hiren, what a delight to have you back. Thank you for joining us.
Thank you, Nikunj.
I guess my introduction was the question in itself.
Yeah.
What should the finance minister do? Everyone has a theory, everyone has a template.
Well, I think there are, let's kind of break it down into 2 or 3 priorities. I think one is that the budget, there's a certain mathematics of the budget that everybody looks at. And there has been this great debate of late whether the government should use some resources and act in a counter-cyclical manner by letting go of the fiscal deficit by a few basis points and not stick to the 3.6 because there is a crying need to kickstart growth because the private sector is not stepping in. So let the government step in and spend that money. So the first thing that people would look at, and it will also give us a peek into the philosophy of the government, is that are they willing to take the risk of being counter-cyclical? I say the risk is because in the past we did a similar stimulus, not to jumpstart investment but to jumpstart consumption in 2008-9 when the crisis happened. We spent 2% of GDP on Narega, on a lot of things which actually bumped up consumption and growth came back. But we are seeing the after effects of that in terms of higher inflation and higher deficits. So, whether he's willing to take that call, that if I pump him in the short term, hopefully the economy will pick up and the revenues then will be enough for me to come back to a prudent fiscal policy. So I think one is to figure out how they think about this whole debate that has come about. Does he say no, I'll still stick to 3.6. I have a little bit of savings because what I've got from subsidy, better targeting of subsidies, and because oil prices have come down, and that is something that I will use, but I'm going to still stick to 3.6. So I think the first is the budget math and the philosophy behind that big budget math that would be seen. Second is that I think that it is now very clear that they need to kickstart infrastructure. So how do you kickstart infrastructure? The problem is today is that because of coal issues, power issues, because of the way the contracts have gone into dispute on land acquisition for roads and so on and so forth, the existing projects are stuck. Yeah. The existing players have debt on their books, right? And to my mind, one of the reasons why that sector is not picking up because the deleveraging cycle is not yet fully over. So you've seen a few of these players starting to sell assets. We've seen some white knights come into sectors and bail out existing promoters by infusing capital. So I think that this is one stage before the investment cycle kicks in. That is, you have to deleverage the sector before it can re-leverage again, right? Now, if you want to, but that takes time. It doesn't happen overnight. The good thing is that at least with this government coming in, a new white knight is willing to take that call by putting in money and saying, okay, I'm willing to infuse capital and because I see an opportunity into the future. So essentially, one way to do it is to come up with new innovative financing structures, and because the banks cannot fund it because they have a capital problem. The private sector banks, the good ones, are not too excited about funding infrastructure. So therefore there is a gap. Who's going to fund this infrastructure? So you have to come up with some innovative financing structures. And there I think that the government will have to play some kind of a backstop. So like an implicit sovereign guarantee will have to be given. that could attract some of the large players. I think there are a lot of sovereign wealth funds and pension funds who have the ability to fund infrastructure projects. What they are not clear is the regulatory framework. So if this government can give it, then I think that money will come and you will be able to break that logjam.
Another big issue is the entire banking sector, the most important wheel for any economy.
Right.
And that wheel is not moving. PSU banks don't have the balance sheet ability. Private banks don't want to, invest or don't want to commit to money in the infrastructure sector. So what could be done and what should be done to really change the dynamics of the banking sector? NPAs are high and credit offtake is at a multi-year low.
Yeah, I think that's a little bit of a complex issue because, I think in PSU banks, my hope is that this government should not be incremental and they should be dynamic. I mean, you look at the Chinese banks, they are all state-owned banks, but look at the size that they've achieved. Look at the amount of capital that they are able to raise, right? So I think that we put on ourselves certain mental constraints that, there has to be some really loud, innovative thinking to get the banking sector out. I know that they had this Chintan Shivar or whatever you call it, a kind of where they got all the bankers together.
Nothing came out of it, unfortunately. The concerns are still the same.
I mean, there are a few things that they want to do, but there are certain constraints because see, look, I think that in order to make drastic changes, you will need parliamentary approval, right? And that might take a lot of time, as we've seen. All of that takes a lot of time. So I think that you will have to work on some innovative solutions to. I think the best solution, according to me, is to come down below 51%.
That may not happen because that they've already indicated that look, government ownership in PSU banks will not come below 51%.
Or the other way out of this is to again create an infrastructure NBFC like they've done the IIFCL, and some more equivalents of that, and bypass the banking sector. And this will be a slow recovery, but you have an alternative funding mechanism and somehow find the way of getting long-term insurance and pension money.
That's the big reform which is required.
That is required. Okay. There is a lot of pension money which is investing in government securities. I mean, if this money can be channelized into some form of infrastructure financing where the government can be a backstop. So even for the pension, you're not taking that risk because ultimately that's all employee money, right?
Fair point.
But that's a whole lot of resources that you need to unlock some of these resources which are just sitting there. And a lot of innovative thinking around financing will have to be done, and probably recapitalize the banking sector in a much more innovative way.
Okay, let's talk about the market setup. Markets are at a historic high. Earnings are just not there. P multiples are expanding. EPS is contracting and margins are static. So for markets to go higher now, what could be the trigger? And if the budget is a miss, let's say on even 2 or 3 accounts, what kind of downside do you think that will open up automatically?
See, I think very clearly, the valuations have reached a certain level. And right now in the short term, there is a dichotomy between what the earnings that we've seen and the valuations. Now, that's not something that has not happened in the past. If we get a very good budget, and considering the fact that global liquidity is still very benign, you may still you may still have a market that kind of hangs around in this range and consolidate before it can move higher. If the budget is perceived to be not that great by the by people at large in the markets, then you may be looking at something like a 5 to 10% correction. A 10% correction is something which is possible where
that's
the
value.
Yeah, I mean that is something which will bring valuations back down to 10-12% correction will kind of bring that valuation back to reasonable levels and more aligned with the current earnings capabilities of companies. However, as I said, there are a few things going for markets. If the RBI governor is convinced about the fiscal consolidation, then they will come in and cut rates. So at least in the short to medium term, you will have some support in terms of rate cuts that might happen. So I think that markets will probably, you can say, either hang around in this range, plus or minus 5%, or we correct by 10% and then we consolidate for a couple of quarters.
So at the current juncture, based on the market dynamics we are working with, whether it's earnings, macro, opinion on interest rate, it's difficult to put in a constructive case for a 10-15% immediate upside.
Well, anything could happen. I mean, if you really have a breakout budget, you could have that. But whether it can sustain those levels is something that we have to see.
So if 2014 was the year of great return and great comeback by equities and as an asset class, 2015 could be a year of consolidation.
I think so.
But bull markets don't move like that. Bull markets always keep on going higher and higher. They rarely consolidate.
So I'm talking about, I'm talking about a consolidation which might be for a quarter or two.
Okay.
At best. You look at the bull market of 2003 to 2007, right? You had a market that was consistently going up, but you had a sharp correction in 2004. It hardly lasted for 2 months, right? You had another correction in 2006, which hardly lasted for a quarter, and the markets were back up again.
So right? Trajectory is higher.
I think the trajectory is clearly up. You might have a pause, you might have a small correction, you might have a consolidation phase, and it's good if the market consolidates and then goes up. Well, I think there are still opportunities if you look. I think this is a market where now you're going to be back to stock picking. So the most obvious names people have already invested in. I think there are certain new opportunities that are coming up. As I said, defense is a big theme, that will come up. I think financials, like housing, could be a big area of
So
growth.
when you say housing, do you like HFCs? Do you like housing home improvement companies? Do you like typical real estate companies? Because if you're bullish on housing was also a function of real estate. It's actually good news for real estate companies also.
Yeah, I think if you look at the entire value chain, okay, right, could be interesting. Home improvement companies could be interesting. Housing finance could be interesting. Real estate selectively could be interesting because today the overall sector valuations are very, very attractive. The problem is that a lot of players are highly leveraged. But if you can find companies that are not leveraged and who have a good business model, there could still be an opportunity from a valuation perspective.
So HFC stocks, whether it's HDFC, a Growth Finance or a Divan Housing Finance, do you think they should be must-have part of a 5-year portfolio?
I think so. I think you could choose whichever housing finance companies that you would like, but it is a big opportunity.
Must-have part of a 5-year portfolio?
I think so. I think you could choose whichever housing finance companies that you would like, but it is a big opportunity. It is a big area of growth, and I think that as rates come down, their cost of funding will also likely come down. I think one of the reasons why also real estate is slow, one is that obviously there's a lot of inventory and people over-invested in real estate. But people expect prices to correct and people expect interest rates to fall. When they know that interest rates are going to fall, why buy now?
Yes.
You'll buy after they've fallen. So I think those next few quarters till the interest rate cycle actually falls might be a little tough for real estate companies. But once you start seeing those interest rates cuts coming through and a little bit of the economy picking up and new jobs again starting to be created, then real estate can start to do well.
The core of your portfolio changed in the last 6 months because the core of your portfolio was NBFC, consumer names, Bajaj Finance, Bata, Dynamic Technologies. Has the anchor changed?
No, I think the core has remained pretty much stable. We have looked at some new opportunities, which you can say about 20% of the portfolio, 30% of the portfolio, we've looked at new opportunities to look at. But otherwise, the core of the portfolio is, we think, reasonably well balanced. I mean, for example, we are also playing housing finance through, we continue to own Bajaj Finance. So we continue to play that because they are now setting up a 100% subsidiary just focused on that business. And we like it because they at least have 14, 15 revenue streams. So it's not just one revenue stream, but it's a very diversified consumer play. So we are happy to hold our core portfolio because they still continue to grow. And 20-30% of the portfolio, we've looked at new ideas in defense, in areas like HR skill development, where we think that there could be opportunities.
But you're not really going down the value chain. You're not really committing too much of capital to cyclicals or deep industrials. You're not walking on that path.
Well, actually, we did that. For example, we do own Concor, as a logistics play.
Classic play on Indian economy.
On the Indian economy. We have. It's not that we've not bought cyclicals. We have a lot of auto companies in our portfolio. A lot of auto ancillaries that we've played, which are cyclical. And again, when we've gone cyclical, we've been careful that we don't want to have balance sheets which are laden with debt. So we are still very careful in terms of what kind of balance sheets we invest in, even if we are at the cyclical end of the market.
It's interesting if I look at the market behavior, a lot of urban FMCG urban consumer names are making a comeback, be it a specialty food, Talwalkar, Jubilant Foodworks. They were expensive stocks. They got a stepmotherly treatment in 2013, 2014, and now they've made a comeback. Now that inflation is down and progressively more job creation will happen, is it time to back the urban consumer more than the rural consumer? Is there merit in thinking on those lines?
I would think so. I think that there will be some amount of mean reversion that will happen. I mean, as I mentioned, that in 2008-9, the focus of our stimulus was to put money into the hands largely to the consumer base in the rural areas.
That is changing.
Higher MSPs, Narega, etc. All of that, and also in general, agro-commodity prices were on the upswing. Now we have the reverse situation. We still have a Narega, but the incremental allocations are not as significant. Many crops are trading at below MSPs, right? So there is some pressure on the rural side. I think the urban story could get a leg up. The urban consumer story will get a leg up, and because these stocks didn't go anywhere, they consolidated for a long time. Now people are taking a bet that that is where the big opportunity will be. And I think there are some interesting opportunities there in categories where the penetration levels are still very low. Foods. You mentioned restaurants and health related, and a lot of those areas where the penetration levels are very low. So you could see a 20-25% compounding for the next 10 years in some of these businesses.
So that's an interesting thought. Focus on companies where the category penetration is not strong, reach is low, and where they have some degree of brand advantage.
Yes, okay. Absolutely.
You've always liked mid-cap IT. Mid-cap IT stocks are still available at throwaway levels. In fact, for the longest time I can recall, IT sector P multiples are actually lower than the P multiples of the entire market. Is that an opportunity? NASSCOM is confident of a double-digit growth, which means growth is clear.
Yeah, I think we have exposure. We've not reduced our exposure to IT. We continue to like that area. I think that there is an opportunity there coming up because of the whole digital opportunity there is massive. Europe as a continent is now outsourcing more, and some of the players have now again waking up and making acquisitions in these specialized areas to build up their capabilities. They have the cash. So I think that while organic growth may be steady, but if they can use that cash creatively to acquire and increase their growth, it would be interesting. And I think that the proliferation of the digital media, social media, is likely to keep tech spending high, because business models are changing even for traditional people. I mean, you could see for retailers, I mean, so much of the action has moved. Yeah, the experience has changed. People have to spend now, they have to have an e-commerce strategy, they have to have some kind of a social media strategy. So that's a secular trend in technology.
So I'm going to keep up with that strategy and take some Twitter questions. Some Twitter questions have come for you. All effect of social media. Like I always tell you, first was industrial revolution, now it's a digital revolution. So the first Twitter question we've got for you from one of our viewers is that, how do you really judge a small cap company which has potential to become a large cap company? What are the 2 or 3 factors you always consider?
See, I think the biggest, one of the few things that you need to look for is the area in which it is. The external opportunity has to be significantly big. Only will then the small cap become a big cap. So, right? So don't look for niches.
Okay.
Don't look for niches. Look for large opportunities. Right? I'll just give you an example. Like, let's say defense. Like, there may be, now what may happen is that there may be large established companies which will also take a shot at defense, but there could be smaller companies who focus on that area, and given the opportunity that is there, some of these companies can become big in the next 5 years or 10 years. So A, look for large external opportunity. B, look for very good quality of management.
Okay.
That is very important in a small cap company. The governance standards, the quality of the management, the quality of the entrepreneur, how well aligned is he to the business? Is he running too many businesses? Is he just focused on that business? Most likely, if he's running too many businesses, you don't know, where he's, where his attention and his value creation is going to lie. If he's only focusing on that one business, you know that this is his blood, this is his life. He's going to give the best to it. So look for a good committed entrepreneur, clean, governance standards. So you'll have to do a little bit of, either talk to your advisor or your portfolio manager or whatever, or leave it to specialists who do that very well. There are a lot of good, small cap mutual fund schemes. There are portfolio managers or there are advisors. So take some help, because you may have to go through the fine print and look at the balance sheet and visit those companies and do that. So large opportunity, a good quality of management. And the third thing would be that give time to your investment. Patience. One of the strategies that we've also used very successfully while investing in small and mid cap stocks is that we don't go and buy everything on day one.
Stagger your purchase.
You stagger your investment. You invest and you monitor that investment. You see how your hypothesis is panning out or not. And as your confidence increases, even if you have to add your investment at a slightly higher price, it makes sense. Yeah. Because the opportunity is so big, right? So it's not as if that you're going to lose everything. You can't have the attitude of buying everything at a bottom. That is something you could do for a large cap. Because if a large cap corrects sharply, then you put everything on day one, because everything in, because you know that this is a company that you can trust. So layer your investments, and that's the way you play it.
So brilliant analysis. Thank you for your words of wisdom. To identify a multi-bagger, according to you, first we need to have the vision to see the business, courage to buy, and patience to hold
it. Yeah.
Patience is the rarity.
Very, very important. Very, very important.
Appreciate your time.
Thank you so much.
Yeah. That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.